Hello and welcome to a sneak peek into LatentView's larger conversation about measuring success, moving from numbers to narratives, and how do you measure the success of a reprioritization strategy. We discussed this on the 14th of July at the LatentView Analytics Roundtable in New York City. Joining me today is one of our three panelists, Kurt Engleman, Finance Chief Risk Officer at Capital One, one of the largest banks in the US today. Kurt, welcome and glad to have you with us today.
Thanks, Shiraz. It's good to be here.
All right. So, Kurt, from your vantage point as CRO of a top 10 bank in the US, what are you seeing as the key reasons for the reprioritization of risk management strategies today?
Yeah, thanks for asking. And yes, I do work at Capital One, but I will give the disclaimer that anything I say is my own personal view, not necessarily the view of the company. But thinking about like why risk is being reprioritized, we're in I think there's different economic headwinds coming out of the pandemic. And so I think a lot of companies are going through restructurings or reprioritization strategies to focus on new things. As you change, like risk becomes an important topic. And the way that I think about or at least I have a framework of how I think about things is generally along the lines of people, process, and technology. And that's kind of a framework that applies to everything in business, but you can also think about how risk filters through that framework. And, as I mentioned coming out of the pandemic and new sort of maybe economics or customer behaviors on the people side, I think you've seen a lot of customer behavior shift to be more digital post-pandemic. When people were at home more often, they figured out how to interact with companies and other individuals in a more digital way. And I think a lot of that behavior has persisted even post-pandemic. But thinking about the maybe technology aspect there and the people behavior change, in a digital world, there are different things to think about from a risk perspective. For example, cyber vulnerabilities are more prevalent when you think about cybersecurity in digital platforms than maybe kind of in person. So when I think about risk across those lines, I think about, well, customer or people's behavior has changed a bit to be more digital. Cybersecurity is probably like a higher thing in that element. And so figuring out how to shift your risk strategy to focus a little bit more on, maintaining up-to-date platforms and making sure cyber vulnerabilities are addressed quickly because that's a gateway that's more prevalent to your company, I think becomes really important. So kind of in summary, like I think risk can filter through everything, but that's a more specific example of a post-pandemic type behavior.
And of course, hindsight is 2020. But if we think about that shift to digital behavior, and if we think of the events of the last 6 to 9 months, I think that was one of the key factors in making money movement a lot faster. And so the whole concept of bank runs has kind of undergone a sea change. And how do we therefore try to address that in the times ahead, in terms of maybe avoiding what we saw at Silicon Valley Bank or at Signature?
Yeah, so I think the traditional vision of a bank run is like a line of people standing outside of a branch to remove their, talk to a teller and get their money out. I think with as you highlighted, the shift to digital means that money movement can take place really quickly. In fact, you could probably move a lot of money just pulling your phone out of your pocket and transferring funds to a different account. So I think, as we think about this shift to digital, certainly there's an efficiency for banks in money movement being digital, but there's the risk associated with money moving quickly, which could lead to like a liquidity crunch or a very fast run on deposits at a bank. I think, like, to me, one of the important things there is a little bit of back to basics, like making sure that a bank has really strong liquidity risk management practices just becomes even more important when money can move very quickly. So there's an element of making sure that you've got the right liquidity. I think the other thing that we noticed in recent bank runs is the idea that uninsured deposits are probably less sticky than insured deposits, and depositors really care about whether they have a sort of a backstop for their bank failing. And I think, as you saw at some of the banks that have failed recently, they had a very high percentage of uninsured deposits. So the idea that you've got to have a really strong liquidity risk management framework and also kind of understand the behavior of deposits, particularly the uninsured deposits, becomes really important. I guess it's always been important, but this sort of put a focus on it being more important, particularly as interest rates start to rise and customers are now not only seeking safety for their deposits, but also sort of a higher yield on those.
Very interesting. And of course, we don't have the crystal ball to figure out the future, but maybe AI is the answer. And we should definitely continue this conversation as we move to the 14th of July at the Pierre at the LatentView Analytics Roundtable. Kurt Engleman, thank you so much. And look forward to our conversation with some of the other panelists, Manny Singh and Pawan Verma.
Sounds good. I look forward to it too.
Thank you.